Hello friends, my name is Masood. Today we shall discuss about a topic that what is financial interest. Friend, today's topic is very interesting, especially if you have interest in different terminologies of finance. So let's start. First of all, I would request to please subscribe to my YouTube channel and click on the bell option as well so that my new videos can reach to you, and also please click on the bell option as well. So what is interest, friend? Friend, interest is the monetary charges for the privilege of borrowing money, typically expressed as an annual percentage rate APR. Interest is the amount of money a lender or financial institution receives for lending out money. Interest can also refer to the amount of ownership a stakeholder has in a company, usually expressed as a percentage. Two main types of interest can be applied to loans: simple and compound. Simple interest is a set rate on the principal originally lent to the borrower that the borrower has to pay for the ability to use the money. Compound interest is the interest on both the principal and the compounding interest paid on that loan. The latter of the two types of the interest is the most common. Some of the considerations that go into calculating the type of interest and the amount a lender will charge a borrower include opportunity cost, or the cost of the inability of the lender to use the money they are lending out; amount of expected inflation; the risk that the lender is unable to pay the loan back because of default; length of time that the money is being lent; possibility of government intervention on interest rate; liquidity of the loan. Now, what is the history of interest rate? Friend, this cost of borrowing money is considered commonplace today. However, the wide acceptability of interest became common only during the Renaissance. Interest is an ancient practice. However, social norms from ancient Middle Eastern civilizations to medieval time regarded charging interest on loans as a kind of sin. This was due in part because loans were made to people in need, and there was no product other than money being made in the act of loaning assets with interest. The more deviousness of charging interest on loans fell away during the Renaissance. People began borrowing money to grow business in an attempt to improve their own station. However, still many people have an opinion that taking loan on based on interest is not right due to many reasons. However, it's depend on their own beliefs. So friend, special consideration: a low interest rate environment is intended to stimulate economic growth so that it is cheaper to borrow money. This is beneficial for those who are shopping for new homes simply because it lowers their monthly payment and means cheaper cost. When the Federal Reserve lower rates, it means more money in consumers' pockets to spend in other areas, and more large purchases of items such as houses. Banks also benefit from this environment because they can lend more money. However, low interest rates are not always ideal. A high interest rate typically tells us that the economy is strong and doing well. In a low interest rate environment, there are lower returns on investment and in saving accounts, and of course, an increase in debt, which could mean more of a chance of default where rates go back up. So, types of interest rates: there are variety of interest rates which include rates for auto loans and credit cards. As of November to 2020, the average auto rate for a 5-year loan for a new car was 4.22%. Meanwhile, for 30-year mortgages, the average fixed rate was 3.22%. The average credit card interest rate vary according to many factors such as the type of credit card and as well as in credit score. On average, the interest rate for credit card as of November 2020 was 16.3%. The subprime market of credit cards, which is designed for those with poor credit typically carries interest rate as high as 25%. Credit cards in this area also carry more fees along with the higher interest rates and are used to build or repair bad or no credit. Interest is the cost to borrow money from an individual or a financial institution. For investors, it can be a reward for saving money in a financial instrument such as certificate of deposit. Interest is generally expressed as a percentage of the principal amount and charged or disbursed on a periodic basis. For example, an annual interest charge of 5% on a principal amount of $1,000 means that the borrower has to pay $50 per year as interest on the loaned amount. While cash is the most commonly used mechanism to borrow and pay out interest, other assets such as inventory can also be used. For example, a building owner may rent out an apartment at reduced rate or free of cost to a lender as interest payment. Perspectives of interest change based on the party's role in the transaction. A lender charges interest and a borrower pays interest, whereas an asset or an investor earns interest. Now, how is interest calculated? Friend, interest charges are known as interest rates. Most commercial and personal loans charge as an annual percentage rate or APR, which refers to the percentage rate of interest charged annually plus fees for the service. An APR can be used to compare two loans with each other. Interest can be calculated in three ways. In simple interest calculation, only the principal amount is used to calculate interest charges. Interest previously earned or charged is not added to the principal amount. For example, a 10-year loan of $100 at 10% simple interest annually would require interest payment of $10 each year. An accrued interest calculation, the interest calculation is accrued or calculated based on the unpaid amount for each month. In the previous example, the accrued interest would amount to 0.027 on a daily basis. Accrued interest is used in instances where regular interest payments are not necessary or can be deferred until the next period. In compound interest calculation, the previous principal amount plus interest charges are added up for a new principal, which is used to calculate fresh interest charges. The interest charged increases exponentially over the duration of the borrowing period in compound interest. In the example cited, I already discussed, if the interest rate is charged on a compounding basis, then interest payment for the next year is $11 because it is 10% of 110, the new principal amount after the first year. These are simple examples. In reality, calculation of interest charges for loans incorporates several variables, which includes opportunity cost for the lender to not use their money, federal funds rate, inflation, loan time frame, whether the lender can collect collateral in the event of a default actually. Okay friend, so friend, thanks a lot for watching the video. I hope you like this video. If you like it, please share it with your friends and colleagues, and thanks a lot for watching the video friend. Thank you friends.